Ticker symbol app is up over 700% in the past year. And today we'll be looking at a stock which is as close to perfect as you can get, which is of course an extreme growth machine with a year-over-year revenue growth of over 41% and consecutive quarters with very high net margin expansion. So today we'll be looking at none other than Applovin Corporation, a digital marketing provider. In their annual report, they state that they're a software platform which provides end-to-end solutions for businesses to reach, monetize, and grow their global audience. In simple terms, they work with different mobile applications, and their main focus is helping them monetize. How? Well, this is through the integration of different advertisements. You know, when you're using a free-to-use application and an ad pops up, well, this is basically what Applovin does. But other helpful features that they offer is that they allow advertisers to optimize and even analyze their marketing investments and the performance of these so that they can optimize their marketing campaigns. On one hand, they have the app discovery section that matches advertiser demand, which means these advertisers which are trying to place their product or their advertising somewhere, with publisher supply, meaning mobile applications which are trying to monetize their work by giving this space to advertisers in order to showcase their products or their services. And they do this in a similar fashion than YouTube or Google, for example, work, which is through auctions, and they do this at a very fast speed in order to best match the advertiser and the advertisement to the person that will be watching this content. Then they have Max, which focuses on optimizing the value of a publisher's inventory. What this does is it gives them a very wide range of different advertisements that they can showcase depending on, first of all, the payment, or second of all, how closely it matches either their values or their current offerings. Now, if this wasn't enough, Applovin also owns a section called Apps that consists of a diversified portfolio of over 200 free-to-play mobile games. They're mainly focused on easy-to-play games, and they're developing more games every single year. And what they do with these games is monetize them themselves, which allows them not only to gain extra revenue and become a bit more diversified, but it also allows them to try and test different services that they're creating every single year and see how these apps react and how their monetization is affected. Some of these solutions that they're creating are actually geared towards different segments, so they want to expand their breadth, and instead of only focusing on mobile app games, they also want to launch out into e-commerce and social media and help those apps actually improve their monetization. And the fact is that they are very attractive because they have a 33% return on capital employed, a 15 times interest coverage ratio, which basically means that they won't have to worry about debt anytime soon. They have an almost perfect cash conversion, and they have very solid margins, with a 74% profit margin and a 27% net profit margin. And this is the main reason why their stock has surged over 700% in the past year. We can see that their revenues had been pretty stagnant up until September 2023, where they started to take off. And this wasn't only their revenues, it was also their net margins. Just take a look at how they went from around 5% all the way up to 25% and closing in on 30% in just 1 year. And this of course has had a very similar impact on their efficiency ratios, where we can see the return on invested capital currently sitting at above 30 times, which is extremely solid. And when we look at their balance sheet, we can see that their total assets are way above their total liabilities, which is something very positive, but I'm not a big fan of them actually reducing their total asset base while increasing their liabilities at the same time. This only reduces the current ratio and makes them look a bit less sustainable. Regardless, we will have to see how this evolves over the long term, because now that they're a lot more profitable than previously, they may actually be allocating a lot of this new free cash flow back into paying back their liabilities and getting that current ratio back under control. And good news is that when we look at their fundamental analysis, this company gets a solid 7.5 out of 8 ticks. As we stated previously, this company has a very low liability risk with a 15 times interest coverage ratio. They have a very solid balance sheet, meaning that they can pay all of their short-term liabilities only using their current assets. And the best part about this company is that their cash flows are extremely consistent and they're growing organically. And why is this? Well, this is being allowed by their very fast-paced organic revenue growth. And by organic here, we mean that they don't depend on mergers and acquisitions in order to grow this revenue. Now, very good news, this company is actually buying back shares as their shares outstanding has been decreasing over the past couple of years, returning value to shareholders. When we look at the two most important factors in this slide, pricing power and existing moat, this company meets them perfectly. Now, as we discussed, this company allows mobile applications to display advertisements on their apps. Well, the way that Applovin monetizes their services is by taking a fee or a cut from the revenue that is generated to their mobile applications. So if, for example, they're advertising a mobile game, and they manage to secure another company to advertise inside this mobile app and pay, for example, $100. Well, Applovin will take a fee from this app just from providing the services and by allowing them to monetize. Now, the great thing is that they can actually increase this fee or this cut depending on how many solutions they're actually selling to the specific client. So if the client is only wanting the ads and nothing else, maybe they can take a lower fee. But the moment that the app starts asking for a lot more solutions, so for example, optimizing engagement, looking at the different analytics and managing their campaigns, Applovin can start to take a larger fee from the revenues generated. And the great thing about this is that customers cannot complain about the cut that Applovin is taken, because if they weren't working with this company, they would basically not be making any money at all. The one challenge that I would have for this idea though is that there is a limit for their pricing power. Once they have set a fee, for example 20%, it would be very tough for them to increase their fee over time. If they decided to increase this fee from a 20% to a 25% from one year to the next, this would open a lot of doors for other competitors to enter their space and take their customers away from them. However, since we're talking about competitors, when we look at their existing moat, I think this company's competitive advantage mainly consists of their repeat customers. If you're a mobile application and you're monetizing through an app like Applovin, and you've started to monetize your application in this way, it would be very weird for you to leave this company and take a risk with a different one. And we can see this in Applovin's numbers. They have an increasingly solid retention rate, meaning that most customers are actually very happy with their service, and they're choosing to keep allowing Applovin to handle their monetization. And this, of course, inherently creates entry barriers to other competitors. And now the only factor that I didn't quite like is that this company does not pay dividends. Having said that, I do understand that they're actually reinvesting all of their free cash flow back into the business to grow a bit quicker. And I don't disagree with that strategy. Now, if we look at their valuation analysis, this company has historically traded at a very hefty premium because it's a very unique value proposition, has high entry barriers, and it's very profitable, especially now. Currently, it's trading at around 100 times their earnings, which looks very high in comparison to the 1-year price to earnings evolution. Of course, this makes sense considering the company is up 700% from the past year. Now, when we look at their free cash flow yield, they're yielding a 1.57%, which when compared to the 3% long-term inflation rate, does actually imply that the company may be overvalued as well. Now, looking at risks and possible challenges, I mainly see two. First of all is their performance on not meeting performance objectives, and this is because they have been growing at such a quick pace, their margins have been expanding wonderfully, while there's a point where their margins won't be able to expand further, or where their revenue will start to slow down. And it's very important to consider and remember that when a company is trading at a very high price to earnings ratio, meaning that Wall Street has a lot of expectations for this company, if their financials start to slow down even by the slightest margin, their stock price will tumble big time. And now the second one that I see is actually a cyclicality risk. They mainly make revenues based on advertisements, and we know that advertising is a very cyclical market because whenever there is an economic downturn that reduces customer spending, businesses usually cut down on spending because they know that they won't get as much return from every dollar invested into these type of activities. So this would inherently decrease the revenues generated by Applovin and their different clients. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I do believe that this company has a strong competitive advantage, consistent cash flows which are predictable, and it has a very high return on capital employed, meaning that it knows how to create value for the investor. However, although I believe that this is a good company and may be a great investment, I think that the fact that it has traded up around 700% in 1 year makes it currently be priced at an extreme valuation, and I wouldn't be comfortable holding a company like this. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.